why do we need to invest? Here are the 5 of the facts that I believe is very important for everyone to remember. So number 1 is the depletion of purchasing power. Now, the Federal Reserve is created in 1913. And imagine if you have a $100 bill in 1913 and you fast forward to 2013, which is 100 years later, the value of the US dollar could have lost about 95%. Right, so this is very self-explanatory of the graph right here. So everyone knows that the value of the currency depreciates over time. So of course, at the same time, we look at the stock market, it has already increased about 55,000%. All right, so this is the chart looking way back to 1897, which is where Dow Jones was actually born in 1897. All right, so but Federal Reserve was born in 1913, right here. So just now what we took was this at this point all the way up to this point, which actually gives us around 55,000% of gains. Of course, it's more than that since 1897. All right. So now, right now, inflation can come into another form. Is that if you buy a packet of potato chips, in the past 10 years, you might have 80% filled in the potato chips packet. But now, it might be about 30% filled with potato. So you get the same price, but it's just less in quantity. So it's like a marketing trick out there. So now, of course, you're not the only one that is actually experiencing this. Many of the consumers in the markets, they also have this, they are also facing these kind of problems. All right, so again, this is a kind of inflation. So now, when we measure inflation, we often look at CPI. And this is one of the macroeconomic indicator that actually macroeconomic indicator that actually tells us the summation or an average prices of basket of consumer goods, services such as transportation, food, and medical care. So it is calculated by taking the price of the changes of each item in the basket of goods and averaging them. All right, so it gives you an overall picture what the inflation is like, so how the price has been increasing. And here is the historical trend of the inflation. Now, if we look at 1913, the CPI is about 10. So if we look at 1970, and this is where President Richard Nixon has abandoned the gold standard. All right, so it is the beginning of the modern day fiat currency, where you can print a lot of US dollar, or you can print a lot of currency without actually pegged to the gold. So there used to be in the past, before 1971, every dollar printed has to be backed by a certain amount of gold. But after 1971, when the gold standard was abandoned, then central banks can print as much money as much money as they want to stimulate the economy. So what actually happened here is that we will actually see a very different rate of change of the inflation. So now what happens is that we can see that in 1913 the CPI is about 10, and in 1970 the CPI is about 40. All right, so and then that's about 300% gain in 60 years. But after this key event right here is that the inflation rate goes up even sharper and within a short amount of time. So it's about 670% within 50 years. But how about the inflation rate per year in average? So inflation rate is about 2.5 per year before 1970. And after 1971, it's about 4% per year. And this is the percentage that worries people the most, is that most of the fixed deposit out there do not pay you more than 4% per year. So the fixed income assets or fixed income investment doesn't have a higher yield to beat inflation. All right, so that's pretty simple fact right here. So is it going to accelerate between 6 and 8% per year? Well, as for so far as for now, we could not see any signs of slowing down in the inflation rate. All right. So now this is one of the in the modern day tools that we can actually chart the US dollar index against the CPI. And this is where we can actually plot the latest CPI against the US dollar to see how it is impacting the currency. So right here we can start at 1986, and this is the furthest data that I could extract from the chart, and it's about 115 US dollar. So right now it's about 33 US dollar in 2021 May. So it has lost about 70% of the value within 40 years. So that's quite a lot, right? Now, also, what is the role of the central bank? And we know it's not a two-side seesaw effect. So they always have to keep the economy stable, all right? And of course, they are there to control the stability of the economy by balancing the interest rates and the money supply against inflation and GDP expansion. Right. So we all know that the central banks, they can do a few. Like what you saw just now, they can actually purchase treasury bonds, which they can lend money to government, and they can purchase corporate bonds. They can lend money to corporate or private companies or public listed companies, and also they can buy the stock markets. All right, which all this goes into owning assets, and this is the balance sheet of each central bank right here. So Federal Reserve is not the only one that's also doing money printing and purchasing assets. And right here, the in the latest quantitative easing, we can see banking in stimulus checks directly to consumers are also very important. So in the past, most of the time we can see is the purchasing has always been in this area of assets. So what happens is that the stock prices move upwards. All right. So, but then if there's no consumption, there's no consumption in the economy, there's no buyer and seller, or there's no trading going on. So one person income spending, sorry, one person spending is another person's income. So that's the very basic mechanism of economics. And when we look at that, is that if we actually, if the central banks they only buy up these assets, that is what we call pushing the string. All right, pushing the string. So now what happens if you push a string? So you have a straight string, and then if you push the string will become crooked, right? Or it bends. Now, so this keeps buying assets will keep the stock prices level up for a certain amount of time. But in the long term, the markets they behave. I mean, the markets they actually react to fundamentals, and they actually in the longer term the market behaves more logically. In the short term, the markets are illogical. So what we mean is that when buying up these assets, they would keep the stock market price afloat. So the capital markets are stabilized at a time. And what we need is that when the stimulus checks are banked into consumers' account, and when they start to spend money, that would drive up the revenues of the corporates. All right, and in turn also it will drive up the earnings also as well. So revenues and earnings, they do actually reflect the performance of the stock and the stock market in overall. So that we call pulling the string. So you have both effects has to be in place, pulling the string. And this is one of the good examples that has been done in Australia. They have been about 30 years, they were not in recession. Is because just when they see signs that there were recessions coming, they would actually bank in the money directly to the consumer's account so that the public could spend the money in the economy so that the economy keeps expanding. The fundamentals of the economy keeps improving. So that once you actually, you have one side that's pushing the string and you have the other side that's pulling the string. So it keeps the string straightened. All right, that's one of the analogy that we normally used. Now, of course, every time we see crashes, uh, these central banks they come in and bail the economy out. And the recent pandemic crash is that what we saw was the purchasing of assets becomes around 300% more than the subprime mortgage crash, right? Already subprime crash in around 2009. So okay, so now right here, what we can see is that the Fed fund rate or the interest rate that is set by the central bank. All right, so it actually becomes lower in time. So right after 1980s, it has not been increasing. The trend has been reducing, and after the dot-com bubble, and every time after a crash from year 2000, we can see the interest rate keeps lowering and lowering. So at the time, it's so low that if we look at the charts right here, it's very near to 0% interest rate. It's also like it is almost like getting lending free money. All right. So now we are back to that area again after the pandemic crash, almost down to zero. Okay. So of course, when the Federal Reserve, when they actually reduce the interest rates, they will also influence the fixed income assets, which is 10 years treasury bond yield is one of the benchmark, and also the 2 years treasury bond yield is also one of the benchmark. So that means for safe income assets, if you invest in it, you don't get a lot of interest rate that is in return. So doesn't matter if it's short term or long term, which I actually plot into the charts right here. Both of these fixed income assets, they yield very low interest rate over time. So, but the only thing that is always going up is the stock market. All right, that's the most attractive one right now. Now, historically, if you look it back about 700 years ago, the global interest rate history documented right here is also reducing. Of course, in every long-term and short-term debt cycle, it has its upswings and downswings. But overall picture right here is that you can see that the central banks are always reducing the interest rate. So this is a long-term trend that we're in. And of course, during World War time, when nobody wants to spend money and everybody wants to keep the money in the bank and there's no circulation in the economy, that the central banks, what they will do is that they'll move into negative interest rate policy. And this is where they drive the money out. The people taking their money out from the bank is either to spend it or invest it so that the economy could expand again. So if you look around these areas, this is World War One and this is World War Two. All right. So it went all the way to negative 10.4%. That means if you save about 100,000 in the bank, you might lose about 10K in a year. All right. So that's quite a lot. Right. So now, also one of the reasons is that the market favors the bull. And the market, yes, the market is manipulated, the market is rigged, and it's rigged by the central banks to actually push the market up all the time. So right here, you can see that the bear markets don't last really long. All right, the winters don't last really long, and you have a lot of long summer days. You can see that after this is one time the greatest crash in the history. All right, that lasts also for 34 months. Okay, that's the longest one. Then other than that, once the Federal Reserve has been doing well has been actually reacting quite well in the market. So they're also being proactive now to keep the bear markets as small as possible. You can see 90% of the time the market is in bullish trend. All right, the market expands more than it contracts. So the market favors the bull. And also, it doesn't matter which presidency takes place or in power, right? So here is the chart that you can see it doesn't matter if it's a Republican or a Democratic president, the markets go up all the time, right? So it doesn't matter which presidency takes place. So now, one of the biggest question here is that, of course, investing is all about beating inflation. And if you look at the S&P or the Dow Jones, it keeps going up. And how far you can beat the inflation? Let's look at the consumer price index. And if you plot that against the broad market index, S&P 500, now you can see there's a very huge spread. And this is just about, let's say, around 10 years time. And here's a huge spread. So you can actually invest in the S&P 500 by buying the ETF. ETF is an instrument that's created to track the performance of the index, right? But ETF, there's many different types of ETFs out there that tracks different components in the markets. So of course, beating inflation was one of the things that we look at. But how about beating the benchmark? Who beats the benchmark or outperform the benchmark all the time, consistently and over for more than maybe 50, 60 years? So now, that company is known as Berkshire Hathaway, and that company is operated by Warren Buffett, the legendary investor. And if you look at 20 years track record right here, you can see that the Berkshire Hathaway performance equity curve beats the index for more than 3 times right here. So that's a huge separation as well. Right? So not only you beat inflation, but if you get to emulate the same performance as Warren Buffett, he doesn't even time the market, and it's all based on fundamentals. And he just keeps invested in great companies. So in times of ups and downs, he doesn't care. He doesn't sell when the price crashes. All right, so he keeps invested in the great businesses. So all right, now can you beat Warren Buffett? Is this possible? Well, of course. So it's possible as a retail investor. So as a retail investors, we do not have billions in our pocket or portfolio. So like Warren Buffett, what is the main constraint is that if you're managing billions of dollars, you're not allowed to buy just a few stocks and expect that you beat the inflation or the market index over time. A few stocks do not have enough volume or liquidity for a company such as Berkshire Hathaway to invest billions into a single company. So they would have to spread out to many, many stocks in the portfolio. And what will happen is that when it gets over diversified, then of course it impacts the performance. All right, but as a retail investor, we do not have problems with volumes because okay, in the market is always regulated, and you have many hedge funds or institutions out there. They are always fighting against one another to compete in buying great stocks, and they're not allowed to own to a certain amount of portion. All right, so they're not allowed to own fully in a single stock. So that's the problem of managing a very huge investment firm. All right, so but when it comes to retail investors, is that of course, most of the time we are below $100 million, right? So we don't have that much of a big portfolio to worry about. So when you're small, you're more flexible, and you could buy into just a few great stocks like Microsoft, Amazon, Google, Facebook, and Apple. And this is the performance that I have actually averaged them in this trading wheel platform. And what you can see is that the red color performance is Berkshire Hathaway. So I just take in about 10 years because Facebook is listed around 2012. So it only limits me around here. I could not plot like 20 years unless I remove Facebook. All right, so here are the main separations. You can see there's about 90, 950% gains within 10 years. And of course, Warren Buffett within 10 years is about 260%. So there's a huge separation between here and here. Right, almost 3 times. So the analogy is like Warren Buffett is like he's moving a big ship, and being a retail investor is like riding on a speedboat. Okay, so now here's a simulation that I took if you invest in the 5 big companies, not only averaging it just now, what we can do is that we can actually simulate this performance by accumulation of the capital. So let's say, for instance, if you have invested USD 50,000 in year 20 and 10. So what happens is that, okay, Facebook, which is in blue color, you can only see the gains, the yearly gains starting from 2003 because it was listed in 2012. So you can see this is flat. So let's say if you even invested about like a 10K in each, so 10K doesn't move much right here. You can see both of them don't move until it's 2013. So right here, if you have invested about 50,000 in 2010, you would have ended up with 574,000, all right, in the year 2020. So right about 10 years, 11 years, all right, 10, 11 years, you would have about increased your capital about 10 times without even timing the markets. So, or you could say that you have increased your portfolio about 1,000%. Of course, if you want to be more meticulous and you want to be more detailed, so I have actually simulated this performance in each of these company in bar charts. All right. So now the very most that you can see, you might have maybe 1 or 2 flat years. All right, one flat year, maybe one flat year, then the next year it starts to jump up. Because if we are not timing our investment, this is for only passive investors, then you might have maybe one flat year or slightly negative year before it starts to boost up a lot next year. So you can see this percentage jump here is even more than probably even more than 30%. All right, so it's all about the patience is the key. And so now just to recap right here is that 5 of these reasons why we should invest. Now here are the 3 reasons. They are always related to one another. Central banks worldwide, they keep printing money and it dilutes, or it debases the value of the currency. And interest rates are always trending lower for 700 years. Consumer price index keep increasing and the rate of the change of the inflation keeps increasing, all right, depending on how fast they print the money. So all this leads to depletion of purchasing power. And of course, what we know is that we position ourselves in a very favorable way, is that we know the stock market keeps going up in the long term. And the possibility of compounding the wealth in stock market is very possible. And this is actually is simulated in the last part of this presentation right here. All right, so now with that, I'd like to thank you for your time. Happy trading and investing. Signing out.